I would always refer you to the lender when you get into specific details about this loan stuff, because honestly, I mean, I know just the basics. I know what I need to know and what I need to tell you, and then thereon I kind of push you over to say, hey, he or she is the expert in this scenario, so let me give you his contact information. That's what you'll hear me say. Mic check. 1 2 1 2. Mic check. 1 2 1 2. That was whack. Hey guys, welcome back to my channel. Today we're gonna be talking about financing. Now I'm not gonna go over like creative financing. This is all traditional financing. This is good for first-time home buyers, second time, third time, fourth time, whatever time this is information that you should know. Now this doesn't, like I said, this doesn't include creative financing, so you won't hear me talk about like owner financing or subject to or anything like that. This is just traditional financing, things you need to know to get traditional lending. Now, with that being said, this information I got from, I work with two primary lenders in the Orlando area, and I did send them some questions and they got back to me with answers. And I do have this, I created a blog on my website, and I did create like kind of like an ebook, first time home buyers guide. So this information you can find online, and I will leave the description below to the link to that. But I'm just gonna go over everything, kind of summarize the financing mortgage part of the blog. So let's get into it. First things first is the different types of loans you can get when buying a house. So you have your traditional FHA, which is the first time home buyer loan, and depending on which lender you go to depends on the minimum score and and the requirements that they require to get approved for the FHA. But the FHA loan is one of the easiest loans to qualify for. They can take lower interest rates, lower down payment, so they usually do the 3.5% down payment. There's a lot of programs for like down payment assistance programs. Excuse me, I don't have COVID. Down payment assistance programs, and things like that. And there's also conventional. Conventional is usually with investors, or if you're like buying a second home or third home, or I mean, this could be your first home and you just have a better credit score, or just, you know, more money to put down, and you're, you know, kind of smart and you want to have more equity when you first move into the house. So conventional is definitely, in my opinion, best bet. If you can't pay cash, cash would be like, cash is king, but conventional is kind of the way to go. There's also VA loans, so for veterans and their spouses. They do, every mortgage lender you go to is different with all the requirements as far as the minimum credit score and things of such. But the VA loan, the good thing about that is they do require a low credit score, not as low as FHA, but a low credit score and 0% down. Now tell me that is not what's up. Then there's USDA loans, and USDA loans are more strict with the requirements. They're limited to certain areas in the city, town, country, wherever you live in. They do have stricter requirements, and that's also 0% down. Now I'm going to go over the pros and cons of each. Now that I explained the different types of traditional loans, I'm going to go over the pros and cons of each depending on what's best for your scenario. Now, disclaimer, everybody is different. Your finances compared to the next person's finances are completely different. Now, with that being said, you may be qualified for one loan, and the next person has the same credit score as you, and they might not be qualified. So it just all depends on you, which is why I recommend first thing I do when I speak to someone who says, hey, I want to buy a house. First question I asked was, okay, have you spoken to a lender? Because they will kind of give you the rundown of everything you need and everything you need to know moving forward, such as what your credit score is, and if you don't qualify, what you need to do to qualify. Yes, now what you need to do to qualify. Not everybody does that, but Jules's lenders do, so get with me about that, and I'll connect you guys. But yeah, so for FHA loans, I mean, this is great for, like I said before, first-time home buyers. It's a lot of leeway because realistically, you know, first-time home buyers, they don't know the process. This is the first time they're kind of learning. FHA does have stricter requirements as far as the condition of the home that you can buy. Not really the location. That's more USDA is more strict on the location, but they're very strict on the type of home you can buy because they don't want to lend. You're already high risk being that you're a first-time home buyer. They don't want to lend something that's kind of falling apart, that's not worth anything, and if you default on your loan and they need to resell it, it needs to be quality, so something that they can resell in the future to get their money back if you default. And they, you know, they have a lower credit score limit. So I do know 580 for the ones that I use, the lenders that I use, 580 is the minimum credit score. Now, that is just the minimum. That's not saying something that you should aim towards. Definitely the higher the better, but 580 is the bare minimum. And then it has a lower down payment, so you got that 3.5% down. So if you have, you know, 200, I don't know where you live, but in Orlando things are going, you know, pretty high. So right now, on average, where I live, where I cover, it's about 300 to 350 is the average sales price in Orlando right now. So say you have that 350 home and you got to put 3.5% down of that 350. Now I ain't gonna get into too much numbers because I don't have my calculator pulled up, but you do the math. And then some cons about it is they require mortgage insurance. I don't know if you know what that is, but basically, to sum it up, what it is you basically have insurance on top of insurance. So this is a premium that you're paying monthly along with your mortgage, added on to your mortgage, for lending it to you because you put down less than, I think it's 10%. If you put anything less than 10%, you have to have mortgage insurance. And this is usually the higher point of your mortgage payment. It adds on probably like another $100 or something. I mean, everybody's different, like I said. So that's something that you got to think about. It's an added cost that it would be cheaper if you just had the money down to put it, you know, but whatever floats your boat. Next would be conventional. So with conventional, with one of the lenders I work with, they do have this program that if you have, I believe it's a 680 or I think it's 680. As long as you have over a 680 credit score, you can qualify for 3% down, which is less than the FHA, and conventional ways better in a, you know, seller's eye, especially in this market. At the time of this video, the market is a seller's market and it's crazy hot right now, and honestly FHA and VA loans are just not, it's just not cutting it. People want to see, you know, conventional actually they're more likely to close, let's just put it that way, because of the less restrictions that they have compared to FHA. But conventional loans, with that being said, they're more lenient on the loan. So this is what also investors, this is the type of loan investors use. This is the type of home people who had multiple properties. This is a loan that they usually use. You can buy a house that's basically good just for the bones of it, and you need to completely renovate. You can buy that with a conventional loan. As long as you have the money down, you're good. So one of my lenders, he does offer 3% down for a conventional loan, but it can go up to 20% down, and then a 640 minimum credit to qualify for a conventional loan. Now, more ways into it to see what you qualify for and how much you qualify for. That is something that you need to talk to the lender about. But if you have over 680, you qualify for that 3% down, and as long as you got a 640, you qualify for conventional. Some of the pros are, like I said, the 3% down, whether it's a first time purchase or an investment property, or a second home for yourself. And then your mortgage insurance can be canceled after you reach 20% of equity. So you remember how I was saying how with FHA you have to pay your mortgage insurance through the life of the loan, unless you get refinanced, which I recommend you do. With conventional, you pay mortgage insurance until you reach 20% of equity. So if, say, you got this $350,000 house, you only put 3% down because that's all you had at the time. But in the future, in the next year or two, you got all this money coming. Say you got hit by a car or something and you're getting a settlement, knock on wood that you don't get hit by a car, but you run into some money and you put all that money towards your loan. Guess what? Boom, you're now saving money for the life of your loan by canceling out that mortgage insurance. Some of the cons are credit score has to be a little bit higher, and PMI, your mortgage insurance, needs to be paid down. PMI needs to be paid if down payment is less than 20%. So if you have less than 20% of your equity, then you need to continue to pay that until you do. And it's harder to qualify compared to FHA. So like I said, the higher credit scores, usually higher down payment and things of such. And then it's kind of same with the VA. VA and FHA are very similar, only that not everybody qualifies for VA. You have to be a veteran or married to, I believe, a relative of some type of relative of a veteran. Correct me if I'm wrong, but I believe as long as you don't have to be married. There's something about that, but I know you have to be associated in some way, shape, or form. I would look into that deeper, but to be qualified for a VA loan. I am not a mortgage lender. My lender is the one who deals with all this. This is just basics 101. I would always refer you to the lender when you get into specific details about this loan stuff, because honestly, I know just the basics. I know what I need to know and what I need to tell you, and then thereon I kind of push you over to say, hey, he or she is the expert in this scenario, so let me give you his contact information. That's what pros about this. The VA loans is it's a great option for those active in the military as well as veterans. So your Navy, Marine Corps, Army, Air Force, Coast Guards, even if you're in the reserves, National Guard, all of that. And they don't require a down payment, so 0% down, and they don't require mortgage insurance. Let me say that one more time. VA loans do not require mortgage insurance, and they offer 0% down. 0% down with no mortgage insurance. If you qualify for a VA loan, I recommend you take advantage of using your VA loan. Let's just put it that way. And then some lenders, I do know, they waive a lot of fees to veterans. So a lot of like the origination fees, points and such, you don't have to pay because you're a veteran. Take advantage. And they also have competitive interest rates and monthly payments. So, a benefit all around. But some cons that they do have is it's only for primary residences. So if you plan on buying an investment property, say you want to rent it out long term or short term, you can't do it. This is primary residence only. And there are some closing costs that's not covered. So even though it's 0% down, you still have to pay some closing costs. But like I said, some lenders do waive some fees. Not all of them. I know the ones that I work with do. They waive some fees, so it'll be less at closing. And then initial funding fee, which depends on the down payment and the number of use. So depending on how many times you've used this loan, and how much you put down. Pros and cons about the USDA loan. USDA loan is a 0% down payment depending on where the property is located. Minimum credit score is a 640. The USDA loan program assists approved lenders in providing low and moderate income households to the opportunity to adequate, modest, decent, safe and sanitary dwellings as their primary residence in eligible rural areas. Eligible applicants may purchase, build, rehabilitate, improve, or relocate a dwelling in an eligible rural area with 100% financing. Do you know what that means? That means you can finance 100% of the loan, the purchase price, towards a qualified home. So rural areas, eligible rural areas. So this is what I was saying earlier, how not every, you basically have to buy a house in a specific neighborhood, and this neighborhood has to be qualified for USDA loans, which is harder to find, especially in today's market. At the time of this recording, it's damn near impossible. Okay, finding a house anywhere is damn near impossible. So to find one that has such strict, restrictions, such as what specific street, what specific area in your city, town, country, wherever, it's hard. But one of the pros is great for people who are looking to live in more rural areas. So if you want to, stay with your peoples where you grew up, you want to help build your community, it's a perfect opportunity to do that and be a homeowner in that community. And there's no down payment required, so you get 100% financing, nothing down. And it's flexible credit and qualifying guidelines. So they do say 640 is the minimum credit score, but it seems like there's kind of a wiggle room there, depending on, once again, your mortgage lender. Cons is the geographic restrictions, being restricted to where you can live. Initial funding fee and monthly mortgage insurance, so that does require your monthly mortgage insurance. And it's limited by your income. So if you can't qualify if you make too little or if you make too much, you cannot qualify for that loan. So with that being said, before you are getting pre-approved or pre-qualified, so this is when you speak to me, you speak to any realtor, you say, hey, I want to buy a home, what do I do next, blah blah blah. You have that conversation with them and they refer you to a mortgage lender. This is what you're gonna need to qualify, to figure out which loan you can get and how much money you can borrow to buy a house. So this is very important that you have recent documents. And I'm going to take out your pen and paper, write this down, or go over to my website. Once again, link in the description below, to get this checklist, because this is very importante. So you need proof of income. W-2s, 1099s, tax returns, pay stubs, any type of proof of income you could provide. Even if it's a letter from your job saying this is how many hours she worked and this is how much she gets paid per hour, per week, whatever, how you get paid. It has to be proof of income. And proof of assets. So you need bank statements. How do you keep your money? Where do you keep your money? Proof of where your money is going. So if you have like your Bank of America card or your Chase or Wells Fargo, they want statements, usually about 2 months. They tell you they want 2 month statements. So you print that out, and that's an easy find. You can go right on your app, right on the website, and print out your statements, download your statements, and send it to an email. 2 months. And that is also like any type of income, whether it's in your bank account, investments, any type of assets you have, include all that. And then employment verification. You need at least 2 years of employment. They do prefer that it's in the same bubble within the 2 years. So you can have, say you worked at, for example, say you worked at McDonald's 1 year and then you upgraded to Chick-fil-A. That's still in the fast food industry, so it still counts. So as long as you got 2 years of the same history, you're good. If you're jumping from job to job, and you're not consistent, then they're kind of gonna look at that and it's gonna turn them off by it. Not to say that they're gonna deny you, but it just makes you look kind of unstable. So they want to see that. And also, of course, government ID. So a license, social security, green card, passport, whatever you got. And then they pull your credit report. So they get this to get a general idea of your score. Now, I do recommend anybody, whether you're working with me or you're working with another realtor, I recommend anybody who's in search of a mortgage, shop around. Take this time out to research who can offer you what, because at the end of the day, this is one of the biggest investments you're gonna make. So you want to make sure that you not only have a right purchase price, that's something that you can qualify for, but also the terms. How much am I paying a month? Am I paying mortgage insurance? How much am I paying mortgage insurance? What's my interest rate? How many points do I have to pay at closing costs? How much do I gotta bring for closing? All this matters. So don't only look at who's offering you the most money. Look at one who is treating you like a person, who has that great communication with you and letting you know and keeping you updated on everything that's going on with your loan file. Because like I said, this is a very this is a big investment. So you want to make sure that the person who's funding you is communicating with you. They're the right person for you. So shop around. I recommend going to between 3 to 5 different lenders. Let them, and then one thing I know a lot of people are afraid of is, I don't want to run my credit. It's good that you're kind of iffy about that, because you don't want to just be willy-nilly letting everybody run your credit. But the good thing about this is, this is expected. When you're shopping for a mortgage, it is expected and kind of pushed for you to shop around. So as long as it's within that 30-day period, you can go to 5 different mortgage companies and run your credit 5 different times, but it only counts as one. So make sure you do all that within that 30-day period. I really recommend within a 2-week span, because you don't want to wait 30 days to whatever. You want to do it right then and there, so you have everything in front of you and you know what to do. I follow a lot of Facebook groups on, usually first time home buyers who got a lot of questions. Sometimes I even have some questions that other realtors or mortgage professionals might be able to answer. And a lot of questions I see is, what's the difference between going to like a bank, like a traditional bank, an online lender, a loan officer, underwriter? What is the difference, right? So I did ask my two lenders, Tiana and Chris Cole, and this I'm gonna read off of the blog that I wrote, but once again, link in the description down below. You could check it out for yourself, but I'm gonna kind of summarize it a little bit. But basically the difference is the license. Who went to school for this? Who's taken more training? Who's able to offer what? Now, the big difference between going to a bank and like online is banks are harder to qualify. When you're working with like a traditional bank like Wells Fargo or Bank of America, they're a little harder to qualify for. So they want to see, one, that you're a member with them. Like if you're not a member with them, they don't even want to deal with you. I mean, I'm pretty sure they'll still take your money, but it's, like I said, harder to qualify. And they want to make sure that your file is like pristine. So you make your monthly payments on time every month, which is what you should be doing anyways. But they're more strict. Now, as far as how they do it, it's within their discrepancy. So you can see one banker who approves you and go to another one tomorrow and they'll tell you no. So it's very like wishy-washy. So yeah, working with a mortgage loan officer, you get more of the one-on-one experience throughout the process. So whenever you have questions, like I tell my people, I always refer them. If you have questions specifically about the financing of things, talk to such and such, because I don't know. It's a good question. I don't know. And like I said, everybody is different. So one answer might be different for another person. So it's hard for me to know. I can't know. I'm not a mortgage lender. I'm sorry. I don't know what your file looks like. I don't know what your debt to income ratio is. I don't know that stuff. Talk to him or her. Once you get that pre-approval saying, hey, your debt to income, which is something that I'm also going to have to go over because I get a lot of questions about what is debt to income ratio. But debt to income ratio, DTI, is basically your debt compared to your monthly expenses that's reported on your credit report, and your reported income. And they see where you're at, and that's your debt to income ratio. Now, obviously, the lower your debt to income ratio, the better, the more you would qualify for, because they see the money you're making is basically paying itself off. You're not deep into debt. You're able to manage your money better and qualify more for a loan. That means you could pay for more bills because you have free reign. So how can I calculate or estimate what my monthly mortgage will be after all the fees? So that is something that your loan officer would provide you with details and estimates of the loan and the breakdown of what everything is, what it means, how much it costs, and kind of give you a more detailed estimate of, hey, so they can't really give that to you until you find a house. So like I said, all the numbers change depending on where you're getting it from. So say, you want this house and it's $350,000. You put in an offer. They say, hey, this is according to this purchase price. If you offer this much on this house and the HOA is this is how much your monthly payments are going to be, including the HOA, your mortgage insurance to the lenders, your interest rates, fees, and even down to how much principal is going to go towards the loan and how much interest is going to go to the loans. So that's very detailed. But once again, you don't know until you find a property. I'm a numbers person. I get it. I'm also one of those people who, if I have a question, I want to know right then and right now. Like, I need to find an answer. That's me. I'm previously an investigator, so that's just in my nature. I need to know. If I don't know, I need to figure it out. So that's one of the things that kind of sucks about it for me personally. I need to know right then and right now. So that's the thing that sucks about it. It's kind of like you can't know until you get a specific property, but we do know around like a range, and that's what they give you. They give you like a range of, hey, what you qualify for and what you're comfortable paying are two different things. Okay. You may qualify for more than what you're comfortable paying. For example, they might say you're qualified for a $400,000 house. That does not mean go shopping for a $400,000 house. You can still get a $300,000 or $350,000 house and still be good. You don't need to spend every single dime of what you qualify for because you might not be comfortable paying it. So they look at your debt to income ratio, and that debt is only what's reported on your credit. That's not to say other stuff you got going on, other bills you got to pay that isn't reported on your credit. That doesn't mean, once again, you go out and spend all the money that they say you're qualified for. Check to make sure that this is something you're comfortable paying, because this is something that you're going to be paying in the long run. This is a long-term investment, whether it's for, you're investing for your business or you're investing in yourself and in your family. Whatever your decision is, you need to run your numbers, and if you don't know how to run numbers, you need to find somebody who does, aka your mortgage professional. So yeah, that's the basics of a mortgage and the lending financing process of things. I know I left out a lot of details, but this is once again the very basic of things. But if you have any specific questions, or you're like, hey, my credit score is a 720, I didn't know I could qualify for that, let me see. Reach out to me. I can get you connected with my peoples. My peoples can let you know what's up, and we can make things happen. You know what I mean? So don't be scared. It's not as hard as people make it seem. People make it seem like buying a house is, so hard. I mean, it is, don't get me wrong, especially coming from generations of people who don't own anything, and they are like in debt, deep in debt. Coming from that, I mean, it is hard, but it's not as hard as, it's not impossible. Let's just put it that way. Anything worth having is worth working for. So with that being said, if you have any questions, comment them. Hit me up on Instagram, Jules the Realty, and slide in my DMs. Let me know what's up. Send me a text message. Check out my website if you're interested in looking homes in the Orlando or surrounding areas. And once again, like I said, if you have any questions or ideas on content that you want me to cover, slide in my DMs. Let me know what's up. I feel like that was mad ghetto.